Stock Dividends Basics Problem 1. Tangerine Corporation reported the following equity section on its current balance sheet. The common stock is currently selling for $18 per share. Common stock, $10 par, 132,000 shares authorized, 52,000 shares issued and outstanding, $520,000. Paid in capital in excess of par common, $136,000. Retained earnings, $301,000. Total stockholders' equity, $957,000. What would be the total stockholders' equity after a 10% common stock dividend? This is one of my favorite questions. It's not because it's difficult. It's actually pretty simple, but it's all about making sure you understand what the question is asking. So we're looking at the total stockholders' equity after a common stock dividend. Let's talk about stock dividends. Stock dividends. You know about cash dividends, maybe when you've seen other problems. You might have talked a lot about that. Stock dividends, students get really concerned about stock dividends because they are challenging to understand. The idea is that in a stock dividend, and there's different ways to account for stock dividends. The way I go about it in my basics videos, I talk about the most common application of stock dividend accounting. There's differences for different percentages for stock dividends, different things like that. The idea of a stock dividend is the corporation is going to declare a stock dividend for each share out there. And so if there's a 20% stock dividend, you own 10 shares, you now are going to have 12 shares afterwards. You're going to have, so if you start with 10 shares and there's a 20% stock dividend, you now are going to have 12 shares. Think about what goes on with respect to a stock dividend. And you might already know this, you might not. Remember, I always start by breaking it down with the basics. Assets equals liabilities plus stockholders' equity. That's right, we got our balance sheet. We're focusing, of course, on stockholders' equity. Stockholders' equity is broken into two parts, paid in capital and retained earnings. That's right, RE, retained earnings. Now remember our little friendly acronym, trusty sidekick, WIRE. WIRE. WIRE, withdrawals, investments, revenue, expenses. The I in WIRE goes under paid in capital. That's where you're issuing new shares of stock. And then the W, R, and E, W for withdrawals, R for revenue, E for expenses, all go under retained earnings. So W, withdrawals, R for revenue, E for expenses. The W is also known as dividends. Dividends. So a stock dividend, it sounds like a dividend, and it is a dividend. It is a dividend, but it's not the same as a cash dividend. In a cash dividend, the corporation declares the dividend, then it actually issues the shares of stock, and then finally it pays, that doesn't issue the shares of stock. That's the stock dividend. Let's start that over. It declares a dividend. So board of directors, it declares it. Then it goes ahead and it determines the number of shares on the date of record. And then finally it pays out cash to those owners on the date of record. So that is a cash dividend. Stock dividend follows the same idea. Its corporation declares a stock dividend, look at the date of record, and then stock certificates are issued. Now, dividends, think about cash dividends. All dividends, they reduce retained earnings. Doesn't matter whether it's a cash dividend or stock dividend. I said to think about cash dividends because it helps you better understand. A cash dividend, the owners are basically withdrawing money from the business. That's what's going on. They're withdrawing money. So dividends, they reduce retained earnings. So the W in WIRE is dividends or withdrawals, and it reduces retained earnings. And in a cash dividend, that's all that happens. Stockholders' equity is reduced. But think about a stock dividend. And if you want to take a second to think about it, what does a stock dividend do in the end after you consider all the events to stockholders' equity? It does nothing. It's equal. What's happening in a stock dividend is retained earnings is reduced, but then paid in capital is increased by the same amount because basically you have a dividend that's reducing retained earnings, the stock dividend, and then you're issuing stock certificates with that amount. Also, if you think about it, if a company issues or declares a stock dividend, the owners that own the business as of that date, on a certain date, they're just going to have additional shares of stock. Yeah, they can go and sell those shares of stock to new people and maybe, and they'll still have their remaining shares. So it does provide some economic value in a way because you have these new stock certificates and maybe the company goes up in value in the future and you're able to sell off those shares. But the idea is that all you're doing is moving money from retained earnings to paid in capital. the same amount, because that retained earnings that's being reduced, you're increasing paid-in capital by increasing new shares of common stock, preferred stock, whatever the stock dividend are, whatever the stock dividend is. So the idea here is that stockholders' equity, as a result of a stock dividend, is going to be equal before and after. And again, it's because the amount that retained earnings goes down by, paid-in capital goes up by the same amount. So it's equal before and after. So if we're asked, what would the total stockholders' equity be after a 10% common stock dividend? It's going to be what it was before, which is the $957,000. Look at that. Boom. We didn't even have to really write much. I mean, of course, I wrote out all this stuff to help you understand it, but not really a lot of calculations. It's just understanding what the question's asking, understanding the rules, understanding what a stock dividend does to stockholders' equity, and boom, you just determined that the before total stockholders' equity and after are equal.